A very good morning to each and everyone. Now, today we will be discussing capital structure. Now, what do you mean by the capital structure? That we have to discuss. Last time we had discussed the cost of capital and the capital budgeting. Now, for that particular purpose, you need to raise the funds. Now, when you have to raise the funds, how you have to raise the fund, how much will be the fixed income bearing security and how much will be the variable cost security. It can be the debt, it can be equity, it can be the retained earning, or it can be the preference shareholders, or you can raise the loans from the market also or from the bank also. Now, how much the debt and how much the equity, the ratio between the debt and equity is called as a capital structure. Now, when we have to go for the capital structure, just see, it refers to the relative mix of the debt and equity. Now, when there is a relative mix of the debt equity, the question arises that in the case of the debt is always a cheaper source of finance. Why? You have to understand that why it is a cheaper source of finance, there are main two reasons. One is that because it is relatively very less risky, because the company has to repay the funds, the principal, as well as the interest. Fine. Therefore, from the person's point of view, from the investor's point of view, they are very sure that they will be getting back their interest also and their principal also. That's why one of the reasons why it is a cheaper source, because the risk is less. The second reason is because it is a tax deductible thing. When it is a tax deductible, that means the return or the interest which the company is paying to the investor is a charge, is an expense, and therefore the company gets the tax deduction on that. As a result, when the tax deduction is there, that means the cost to the company will be less thing. As a result, the debt is a cheaper source of finance. But the equity, you can argue with me and you can ask me the question that in the case of the equity, there is no compulsion from the point of view of the company that they have to pay any cost. If they want, they can declare the dividend. If they don't want, they will not declare the dividend. That means you can say, ma'am, that in the case of the equity, there is no compulsion, no liability is there. Therefore, that is much cheaper as compared to the debt. No, this is a wrong connotation. Why? Because in the equity, why a person is investing the money in the equity? Person is investing because they want a return. Okay, I do agree that in that particular case, the company has no liability to pay the dividend. But at the same time, the investors or the shareholders have got the expectations. When if the company is not meeting their expectation, the share price will go down, the value will come down. As a result, the company has to maintain a proper debt equity ratio. Here in the capital structure chapter, we'll be discussing what will be the optimum capital structure or what would be the optimum debt equity ratio. If I go for that, then in that case, we have to find out that whether there can be an optimum capital structure. If there is an optimum capital structure, then in that case, the value of the firm will go up. Okay? And therefore, just see whether the capital structure matters or it does not matter. It really depends upon that whether the ratio of the debt equity is optimum or not. Now just see, if the capital structure is the optimum one, the total market value of the firm securities will increase. Okay, when it increases, that means the value of the firm will increase, the EPS will increase. Okay, now just see, it refers to the relative mix of the debt it refers to the relative mix of the debt and equity. Fine, therefore, remember, if it is a short-term finance, I'm not taking into account the short-term finance. I'm taking into account only the long-term, the permanent nature finance. Okay, that means we have to find out at what level my value of the firm will be the maximum, and that will be called as the optimum capital structure. Okay, now for that, we have to find out that what are the various factors determining the capital structure. There are certain principles for that. The first principle which I'm going to discuss is the cost principle. Cost principle, I've already discussed with you that debt is a cheaper source as compared to the equity. Okay. The second principle is nothing but the risk principle, because remember, in the case of the debt, there is a risk, while in the case of the equity, there is no risk. Why there is a risk? Why I'm saying that there is a risk in the case of the debt? Because in the case, if the company has got the cash flow problem, then in that case, the company has got the liability, whether they will sell off the assets or whether they will borrow it from other places. They have to pay the interest, they have to repay the principal, and hence the risk is there in the case of the debt financing. Okay, the next one would be that the risk can be of two types mainly. One is a business risk, just see, it's a business risk, and the second is the financial risk. Okay, now in the case of the business risk, it's inherited. It depends upon under what circumstances you are managing your fund, managing your business, and therefore the environment. That means that will be there. But in the case of the financial risk, that the company can manage on their own, depending upon what is the debt equity ratio. Now, if it is there, then in that case, just see that how you have to do it. Just see here, the financial risk, it is the risk associated with the availability of earning per share caused by the use of the financial leverage. Now, just tell me that if you are using, suppose 100 rupees you have to raise, and then the debt is 40 and the equity is 60 at one point of time, and you have raised the debt at 10% rate of interest, but you are earning 12%. When you are earning 12%, that means 2% you are saving on account of that 40% which you have raised through the debt financing. That means that 2% will go to the equity shareholder, and the return to the equity will increase because you have used the debt financing. The third principle is the control principle. Now, in the case of the control principle, you please remember that in the case of the debt, it's a liability, it's a borrowing. That means no ownership is there. While in the case of the equity, there is a ownership. Equity is nothing but the ownership capital. Okay, that gives you the right of the ownership. That means here we have to really understand that if we issue more and more equity, the control will be diluted. And hence, while deciding the capital structure, we have to find out, and we have to really understand that how much should be the debt and how much should be the equity. Another principle which we are taking into account is the flexibility principle. That is, here it is a combination which we have to be adjusted according to the changes. Now, what are the other factors? The other principle is the flexibility principle. Now, in the case of the flexibility principle, you have to understand that we have to adjust the capital structure according to the changes in the needs of the fund in the future. What do you understand by that? Suppose in the future I need more fund. Is it that today if I raise the funds throughout, what I have to raise, suppose 10 lakh, and all the 10 lakh I raise through the debt financing by taking the loan from the market? Is it not that the ratio of the debt to equity will change? That means in future I'll not be able to raise through the debt, but I have to raise through the equity only in order to have that optimum capital structure. And therefore, in order to have that flexibility principle, we have to understand that whatever the additional funds we are raising, we should raise in the optimum ratio of the debt to equity. Is it okay? Now, the next one, there is only these are not the factor. There are other factors also, just see, the nature of the industry is a very important factor. Then the timing of the issue, the state of the economy, the capital market status, what is the economy status, what is the global market. According to that, the competition of the industry, according to that, we have to decide upon that how much should be the debt and how much should be the equity. Just see, the industries which are facing the severe competition, that will have more equity as compared to the debt. Now, remember why we are giving so much stress on the capital structure, because it affects the cost of capital. When it affects the cost of capital, that means it affects the value of the firm, it affects the price of the share, it affects the earning per share, and therefore this is a very, very important thing which we have to understand. Now, what it affects? It affects the debt equity mix, and it affects the shareholders' return and the risk that I have just told you. That means now we have to understand what is the significance of the capital structure by other factors. Now, here, beyond limit, if you increase the debt, it will lead to increase in the risk in proportionately. That means it will increase the risk to beyond our capacity, and the expectations of the shareholders will increase. As a result, the price will decrease if the return to the shareholder is not according to their expectations. And therefore, what we have to do is we have to find out that what are the main principles of the capital structure. The first one which I can tell you is called as a leverage. Now, what is a leverage? Leverage is nothing but the percentage change in the dependent variable upon the percentage change in the independent variable. Now, what do you understand by the percentage change in the dependent and independent variable? Dependent variable, suppose I incur the expenditure on advertisement or on proportional expenses. I want to find out and take the decision whether I should incur the expenditure on promotional expenditure or not. I'll find out that what will be the effect of that expenditure on my sales. Okay, when it will be there, then in that case, if I try to find out what will be the effect on sales, then in that case I can take the decision whether the promotional expenditure should be incurred or not. That means the sales becomes a dependent variable and the promotional expenditure becomes the independent variable, and the ratio of the two is called as a leverage. Just see, read the example. Now, if the firm increases the sales of the promotional expenditure by 5,000 to 6,000, that means how much is the increase? The increase is only 1,000, and 1,000 means 20%. Okay, how 20%? 1,000 upon 5,000. And that is an increase of 20%. This results in increase in the number of units sold from 200 to 300. Can you tell me how much is the increase? 100 unit increase is there, and 100 unit upon 200, that is the initial, that comes out to be 50%. Okay, the leverage between the promotional expenditure and the unit sold will be defined as, that is the percentage increase in the dependent, that is the unit sold, that is 50%, upon the percentage change in the independent variable, that is the promotional expenditure, to 50 upon 0.50 upon 0.20, that comes out to 2.5. What do you understand by the 2.5? That means if I increase the expenditure on promotional expenditure by 1 rupee, my sales will increase 2.5 times at that of a promotional expenditure. And therefore, what I'll say, what will be the decision? Can you tell me? The decision will be, yes, I should go for the increase in the promotional expenditure. That is how the leverage really helps me in decision making. Now, just see, what is an operating profit? Do you understand what is an operating profit? Operating profit is from the sale. If you deduct all the expenditure, then in that case, that will be called as a operational expenditure. Please remember, not unoperational, not non-operational, only the operational expenditure you have to deduct it. Okay, and therefore that will be called as an operational profit. Just that I have just given you in the form of a table in order to understand very easily. We will be having the sales revenue, that is a dependent variable, minus the variable cost, and after the variable cost reduction, whatever is the remainder, that is called as a contribution margin. From the contribution margin, you deduct the fixed cost, and hence that will be called as earning before interest and taxes. That is called as a operating leverage. What is that again? Therefore, the relationship between the sales revenue and the EBIT is nothing but the operational leverage or operating leverage, because the leverage can be defined as two. One is the operating leverage, another is the financial leverage. Okay. Now, if I take it from EBIT, now here the dependent is the sales variable, and this is there. Now just you look upon EBIT minus the interest. Here I am taking only the financial cost. Here I have taken the operational cost and therefore that is called as a operating leverage. Here I am taking the financial cost and therefore it is called as a financial leverage. That is EBIT minus the interest will be called as profit before taxation. Minus the taxation gives you the profit after taxation, and therefore the relationship between the profit after taxation and EBIT will be called as the financial leverage. Therefore, if we add up both the thing, if we multiply both the thing, that is the operational leverage into the financial leverage will be called as the total leverage. Okay, just see. Now read it. Whether you have understood, when the sales level increases or decreases, the operating lever measures the relationship between the sales revenue and the EBIT, and that will be called as an operating. Now, I'm giving you the formula for that. That is, the degree of operating leverage is nothing but the percentage change in EBIT find upon the percentage change in the sales revenue will be called as a operating leverage. Remember, the leverage will be there only if the fixed cost is there. If there is no fixed cost in the operating cost structure, or the financial cost structure, there will be no effect on the leverage. Fine. Therefore, we have subtracted in the previous slide, if you look upon, we have subtracted the variable cost first and then the fixed cost. As long as the degree of operating leverage is more than 1, there is an operating leverage. Remember, if you have incurring some expenditure and the sales increases, okay, that may, and my previous example, if I take my previous example, that was coming out as 2.5. That means if I am incurring 1 rupee, the effect is the increase of sales by 2.5 and hence the presence of leverage is there, okay. Now, if you look upon the other one, now, we are coming to the operating leverage. Okay. Now, I have already told you what is leverage. Leverage can be defined in 2 ways. One is the operating leverage and another is the financial leverage. When we are taking up the relationship between the sales and EBIT, that is the operational expenditure, then in that case, that leverage, that relationship will be called as operating leverage. And when we will be taking the relationship between EBIT and EPS, that is the effect of financial fixed cost, then that relationship will be called as financial leverage. Let's start with the operating leverage first. Now, in the case of the operating leverage, I have written here the degree of operating leverage is nothing but percentage change in EBIT upon the percentage change in the sales revenue. Okay. Now, remember that as long as this relationship is more than 1, there is a presence of operating leverage or any other leverage. Remember that thing. Now, when the degree of operating leverage is this much and I'm getting more than 1, then in that case, we have to really understand that we should take up the decision to incur that relationship or that cost. Okay. Now, just see, operating leverage is determined by the amount of the fixed asset used in associated fixed cost. This I have already told you that if there is no fixed cost in the operating structure, there will not be any operating leverage. And that is what I had given you, that presence of the fixed cost is very important for the presence of the leverage. Now, higher the amount of the fixed cost, higher will be the degree of operating leverage and hence higher will be the risk. Remember that, which means higher the operating risk. Why? Try to understand this concept. I have got more fixed cost. That means if my sales decreases, that means I'll not be able to cover up my fixed cost. I'll not be able to have my break-even point and hence I'll go into the losses. At the same time, the other thing also there, that if the sales increases, then my operating leverage also increases. And therefore, remember that higher the operating leverage, higher will be the risk. Okay. Another thing, if you understand the next case, then you will see that in the case of the operating leverage, the operating risk is associated with the asset side of the balance sheet, which is really an important thing, and you have to remember that it is associated with the asset side. Again, just see DOL, degree of operating leverage, is nothing but the percentage change in the operating income upon percentage change in the unit value. Now, previous formula I have given you in the terms of rupees. Here, this formula I am giving you in the terms of units, which you should understand that how we have to do that. Now, in the case of the degree of operating leverage, just see, we can define in another way also, that is DOL is nothing but the contribution upon profit. It's another formula for that. DOL can be, if I have to find out in the terms of the quantity, then quantity upon quantity minus the break-even point, and another would be the quantity into the price minus volume upon the quantity into the price minus volume minus the fixed cost. Remember that these are the same formula, but the variation has been given, and you will be using the formula according to the things given to you in the question, or the things given to you in the question. As quantity increases, DOL decreases. That gives you the risk. If you are increasing the quantity, degree of operating leverage will decrease. Okay, and therefore this is the relation between the quantity and the DOL. I told you it will go on decreasing, and hence this is the thing. The more we produce and sell, the less will be the operating risk, because the maximum amount of the fixed cost will be covered up, and therefore after the covering up of the fixed cost, we will be getting the profit out of that deal. Okay, and therefore this is the relationship between DOL and the quantity. Quantity you have taken on the x side, and DOL on y axis, and the curve is coming down here. But remember, it will not touch the x axis. That's a very important point which you should understand here. Now, I'm just giving you a relationship between the investment decision and the operating leverage. Just look upon. You have invested some amount of the funds, and then it determines the amount of the fixed assets which are there in my operating structure. And whatever is the amount of the fixed cost, that will determine the operating leverage. That I have already told you that leverage is that. And hence the operating leverage leads to operating risk. Okay. Now here, again, operating leverage exists because of the presence of the fixed cost in the cost structure of the firm. And therefore, the operating leverage, therefore, is the ability to magnify the effect of the change in the sales over the level of EBIT. This is very important and very useful thing in actual companies. Okay, and therefore now you can read it. Here I have given you the concluding points of the operating leverage, that operating leverage reflects the amount of the fixed cost embedded in the firm's operation. If there is a high percentage of the firm's costs are fixed, remember, the more will be the certain amount of the business risk as discussed above. Here I have, just see. Just 1 minute. Here, if the high percentage of the firm's costs are fixed, then the sales decline, then the firm is said to have a high operating leverage. And if I'm calculating high, that means high level of risk will be there. And high operating leverage produces a situation where a small change in the sales will lead you to the losses. And therefore, I'll give you the example where I can prove this point. Now, using the input data, we examined the firm's profitability under two operating plans in different states of the economy. Now, just see, read this. I've taken two plans, Plan A and Plan B. Plan A is less risky and it has got low fixed cost. Why? Therefore, A has got the lower break-even point. That's an obvious thing. Now, in plan B is more risky, it has got more fixed cost and therefore has got a higher break-even point. Again, it's a very obvious thing. You had already read the break-even point. Plan B is more profitable to plan A. This is the situation I have given you. Now, let's see. Now, in plan B, if I study the risk, then in that case, you will find out that operating leverage is nothing but the contribution upon EBIT. That means, higher the level of fixed cost in relation to the variable cost, greater will be the degree of leverage. And therefore, DOL at any particular sales volume also will be calculated as the ratio of the contribution upon EBIT. If you look upon here, just read the operating leverage. I have already told you it's nothing but the percentage change in EBIT as a result of 1% change in the sale, and which arises because of the fixed cost. Therefore, suppose it comes out to be a positive. There can be two situations. One, it can be positive. Another, it can be negative. If it is a positive thing, a positive DOL means that the firm is operating at a level higher than the break-even point. Why? Because after the break-even point, there is a profit. But if it is a negative thing, then in that case, it shows that it is operating below the break-even point. Okay? Now, just see, here I have given you the negative thing, that it is lower than the break-even point, and hence, high DOL increase the operating profit, while low DOL decreases the profit. That is, the EBIT may disappear and even lead to the operating losses, and if there is a decline in the sales. Okay, and hence the firm should always try to avoid the operation under the very high DOL. Why? You give me the answer. Because high DOL means high risk. High risk means it can lead to the losses also. Therefore, a small change here or there in the sale will lead to the losses, and therefore we should avoid high DOL. And therefore, what could be the conclusion here? That the firm should try to operate at a level sufficiently higher than the break-even point so that the chances of losses because of the fluctuation will not arise. Okay, now just read. Here I have taken the example of ABC Limited, that which sells 1000 units at rupees 10. Okay, the cost of the production is rupees 7 per unit, and the whole of the cost is a variable cost. In nature, the firm is able to increase its sales by 40%, resulting in the total sales of 1400 units. Now understand the calculation. Very simple. I want to highlight one of the main important points in the case of the leverage. The profit of the firm at 1000 was, it's very simple, that is 1000 units into 10 minus 7, because 7 was the variable cost, and 3 rupees, that means is the contribution. Take 1000 into 3, that gives you 3000. But the profit of the firm at 1400 units would be again 1400 units into rupees 3. That comes out to be 4200. So the operating leverage will be, ध्यान से देखिएगा. What was my formula? Formula was increase in EBIT, percentage increase in EBIT upon percentage increase in the sales, or the increase in EBIT, that is 1200 upon 3000 upon 4000 upon 10,000. Now understand, because there is no fixed cost, I was really stressing upon the presence of the fixed cost. And here intentionally I have taken the example where there is no fixed cost. As a result, here just see, it is 1. That means no operating leverage. Have you understood this thing? That no operating leverage because it is coming out to be 1. What I told you previously, that leverage presence will be when it will be more than 1. Okay, now just see that operating leverage of 1 denotes that the change in the EBIT and the change in the sales is of the same value. As a result, this is due to the fact that there is no fixed cost. This point you have to really understand, okay? And therefore, here, what would be the conclusion here? That increase in EBIT upon the increase in sales is this much one, and therefore, here you have to understand this is there. But I've changed the example a little bit. If the firm has 1,000 as the fixed cost in the same example, okay, now the presence of the fixed cost is there. When the presence of the fixed cost is there, just see the calculations. 10,000 minus 7, as I had done already, that is 3,000 was the contribution. Out of the contribution, the fixed cost has been deducted. That is equal to 2,000. Now, in the second situation, it is 14,000. The variable cost is 9,800 because it is 7 rupees into 1,400 units. That comes out to be CM as equal to 42, and the fixed cost remaining the same. That is the definition of the fixed cost, 1,000, and hence EBIT comes out to be 3,200. Let's calculate operating leverage in this case. If you calculate, now here it comes out to be 1,200 upon 2,000 upon 4,000 upon 10,000. I hope you have understood this because I have given you percentage change, and that is the increase percentage change in EBIT, that is the increase in EBIT I have taken up, and therefore now the answer is 1.5, which is more than 1, and if it is more than 1, that means the presence of operating leverage is there. The operating leverage of 1.5 denotes that there will be more than proportionate change in the level of EBIT as compared to the change in sale. Understand this logically. What happens is it is more than 1.5. Why it is more than 1.5 beyond the break-even point? Because whole of the fixed cost is being recovered. And now whatever is the contribution margin, that is towards the increase in the profit only. But before the break-even point, that contribution margin is being taken up for the recovery of the fixed cost. And hence, what happens is, here it is these figures of 1 and 1.5 are known as the degree of operating leverage. Now, just see, if the level, again, I'm taking another example to tell you how at various levels it will change. Okay. Now, if the level of sales changes, the DOL for the new level of sales, there in the previous example, I had taken the 1,000 and 1,400. ध्यान से देखिएगा, new level of sales may be different. For example, DOL for a sales level of 1,000 unit and at 1,400 unit is as follows. That will be different. That is 10,000, again the same type of an example, 10,000 minus 7,000 the variable cost, CM आ गया, CM में से fixed cost घटाया, आपका EBIT आ गया. तो DOL हमने निकाल लिया at a particular level. Remember, there I was taking in the previous example at two levels the change. Here I am calculating DOL at a particular level. That means 3,000 upon 2,000, it comes out to 1.5 here. At 1,000 level I am calculating because generally you people get confused. There it is, that is the change. Here at a particular level. Now at a particular level here, it is 14,000 minus 9,800, that is the variable cost. CM आया, CM में से fixed cost घटाया, so that means EBIT. And if I calculate the operating leverage at a particular level of 1,400, it comes out to be 4,200 upon 3,200, and hence it is 1.31. Now the question before you is why it has decreased from 1.5 to 1.31. That's the main point. Just read it. That I had given you in the beginning also that as the number of units increase, DOL decreases. Okay, just see the conclusion that if the firm is presently operating at a level of 1,000 and the change from this level has a DOL of 1.5 as we had seen. But however, if the firm is presently operating at a level of 1,400 units, the DOL has decreased to 1.31 times. Similarly, the firm will have different DOL at different level of operation. That please remember what I told you, as the output increases, as the sales increases, DOL will decrease. And therefore, the conclusion comes out is that the behavior and direction of operating leverage depends upon the state of sales level vis-a-vis the break-even level. If the break-even level is suppose 2000 unit, in any other example, I'm not taking this example, but I'm operating at 2500, that is beyond 2000, my OL, that is operating leverage, will go on decreasing. Okay, is operating at the sales above the break-even level, the DOL decreases. That's the main important point. With every increase in the sales level, the reason being that the fixed cost changes from this level has a DOL of 1.31. It is decreased. Okay, similarly, the firm will have different DOL at the different level of operation, and therefore the direction depends upon whether your present sales is below the break-even point or after the break-even point. And therefore, that is what today, I think, let me finish this, and tomorrow in the other class, I'll continue with the financial leverage. Fine. Thank you.